Welcome everyone to LeapMeet 30 July 2021 TradeLog review and interactive Q&A session. First day of August, we have had a fantastic July to say the least. As you will see in our TradeLog as we go over it, we did make some mistakes, but that's just a part of the whole process. And the important thing about keeping a TradeLog is so that you can go back and take a look at it and see what kind of mistakes you have made and what you could do better and what you need to do more of, what's working for you, what's not working for you, things like that. And that's why keeping a detailed trade log for every single trade that you take is very, very important. I still have trade logs from 7, 8, I still have it at this point. There's like, I have evolved from that, but the only way I've gotten better and better each time with each passing month, each passing week is by learning from my own mistakes, by looking back at what I did that was right or what I did was wrong and what I could have done better. So it's all about that, and that's why keeping a trade log is a very, very important part of your trading journey. So with that in mind, let's get started. Let me share my screen for. Did I share? There we go. So this is the July trade log. So as you guys know, we added these 2 new columns here just to show like give more realistic view of what you can do with $10,000 account. Before we only had like one contract profit and loss. So that was assuming that if you take every single trade that I take, what would be your results? But that wasn't very realistic because sometimes you're not available, sometimes you can't get into a trade, or sometimes trade is big, so it doesn't fit in your trading styles and stuff like that. So with that in mind, we added this 2 new column, namely basically to mimic how and what you can realistic make, or how you should be trading if say your account size is $10,000. So those 2 columns pretty much represent that. So basically, if your position, like if a contract is 60 cents, then you should probably take about like 10 of those, which will roughly equal to about $600. Or if it's $4.20, then you just take 1. If it's like $1.30, then you take 5. It depends, your size varies. So the constant here is that every single position you take is going to be somewhere around $500 to $700. So this basically shows that what you would have done. And as you can see, in very first week when we did it, first 2 weeks actually, and this is going to be the theme pretty much for entire month. This month tech ran up like huge, and with tech we mostly traded like FANG stocks like Facebook, Amazon, Shop, the names like that, and a lot of Twilios, but we traded Amazon and Shop like a lot, and that shows in the trade log because a lot of trades that we took were somewhere anywhere between like $10 to $20, and I know for a fact that a lot of people can't. This is a big trade and it doesn't fit their account size. So this affects the position that you take it, like you enter in. So for example, week 2, day like on 6th, I think it was Tuesday, I'm not sure. But on that day, I personally opened about 7 position. But if you were to have a $10,000 account, you probably would have just opened 1 NVIDIA. position, which was $4, and you would have bought one, and that position actually didn't work out, so you would have lost $400 instead of making huge amount of money that we did trading these other names. And that's okay. And this will show you why it's okay. You don't have to trade these big names in order for you to be profitable at the end of the month. Like, small wins do add up, and you will see this month has been a great example of that, because a lot of big positions that we took, this column would not show it. It will show zero, like this $426 gain position that we took in shop that went almost to 50 the next day. We didn't take it, or things like that. But yeah, so it's a good example of what you can do with, even with a smaller decent size. You trade right, and if you manage your risk well. But anyway, let's get started. So the month started with, like, the week was like basically started Thursday, so it was just Thursday and Friday, 2 days. Things were kind of slow from last month, so we didn't take that many trades, and it was also a day before, like, a long weekend, like a couple of days before long weekend of 4th of July, so we didn't want to take too much risk. We still managed to get some decent gains in about 20 to 30% gain is pretty good on any matrix that you take. It's a pretty decent gain. It's nothing to laugh at. If you continue to take 20 to 30% profit each time, it will start to add up. And I keep telling everybody in the room that your first exit should be around 25 to 30%. And that's how you gain momentum, and that's how you become more profitable. So your entries and exit are matters a lot. Don't think of this as in, like, oh, I have to have a home run. Like, like, if I enter in a trade, it has to go 100%, or at least like 80% up. Like, otherwise I'm not entering it. That's a wrong mindset to go into any trade with. Or don't think of it as like, okay, I'm going to enter in it and I'm going to make 50 cents and I'm going to get out, and I'm going to risk $600 to make that $50. Now, that's also a wrong mindset to go into things with. Like, that's not how you should be trading. Your goal for any position you enter should be somewhere around 25 to 30% return on your investment. And that's how you should be trading. It not always works. Like, for example, the snap, that didn't work. We pretty much got out break even because trade failed. Or Amazon, we got out at 17%, or 12% for shop, so, or 2% here for Amazon. So it doesn't always work that way. But if you see like a pattern here, you will see that most of our exit has been anywhere between 20 to 40% on average. And that's what you should be aiming for. One of the things that most people forget or not realize is that there is nothing in trading that's absolute. There is no way anyone at all can predict this is exactly how it's going to happen, and this is exactly what I'm going to do. There is no way to do it. There is nothing in trading is absolute. Everything is fluid. Everything is evolving, changing, going time. One thing is, though, anything that's happening right now, for most part, has happened before in trading history and stock market history. So you can learn from past data, but that data is to guide you. It's not to tell you that this is how it should be happening. Like, I've seen people looking at each candle wick. I've seen people trying to find top and bottom of the trend or a day, or, okay, I'm going to enter at the bottom. I'm going to go up to this point and I'm going to sell. You can't do that. There is no way to do it. Your job is to enter at a position that gives you an edge over other people and the stock market itself, and capture meat of the move or bulk of the move, as you say it. So you don't have to capture 100% or 80%. You capture 20%, 30%, and you keep on doing it, repeating it. But that's how you become profitable. So don't think of anything as an absolute. Like there is no 100% way to predict or do anything. It's always changing. So you have to be fluid. You have to keep changing with the stock market. You have to be okay. Like my goal is to make 25%, but it seems like that now the whole market is heading down. So I'm gonna get out flat. I'm gonna get out at break even, or I'm gonna get out at 2%, or I'm gonna get out at 15%. Oh, market is doing the way it's supposed to be doing, or the way I thought it should be doing, or it would do. Let it ride as long as it can, and then once it breaks the trend, I'm going to get out. So what you're doing essentially is you're adapting to the market environment. Trend line is another good way of letting market do its thing and sort of like predicting its direction, so you can capture bigger move and stay in the trade longer than you normally would. But these are the things that you have to keep on adapting. You can't just be like, okay, I'm going to enter it here, exit here. I'm going to aim for that 10 cents or 20-cent scalp. But it could work. It works for a lot of people. I'm not saying it doesn't. And I'm also not claiming to know everything, but this is what I know, or my perception of the stock market, that it's always evolving. And if you don't evolve, if you're stuck, or if you try to do everything perfectly, it will never work. That's just my perception of it. Anyway, so yeah, first week was very slow. We took it that way too. The second week, we only had 3 days of trading in that one. And that would actually, no, we had 4 days, but first day kind of worked really good. We took, as you guys can see, we were coming out a long weekend, market was running up. We took quite a few trades on that day, again, because market was running. So as I always say, when market is running, you put the hammer down, but not as in like you size up like crazy, or you just like keep on trading for like 10 20 cents. No, that's not what I mean. Like every single trade that we took, like most of the trade returns like 40 37%, 33%, almost 20%, 63%, 23%. So almost every single trade still return 20 to 30%, even 60% return on our investment. But when I say put the hammer down, meaning that don't be hesitant to take a new position. There's a saying that what is higher will go, what is high right now can go higher, and what is low right now can go lower. So just because something is running up a little bit doesn't mean it cannot run further. So then you will ask me, what's the difference between chasing and this? So chasing is basically, if a stock has ran up like 50 points straight up in 10 minutes, and then you decide to enter at that point while it's up already up 50%, that's chasing, because you did not wait for correct entry. The other thing where I said that what's high can go higher is basically, yes, it can go higher and you can still continue to trade it, but you have to wait for a perfect entry. And what would that be? A small consolidation, a small pullback, and you wait for that pullback and you enter on that pullback, or you enter when it's breaking above a whole number after a certain amount of consolidation. Now you're not chasing, you're waiting for that breakout at that point, or you're waiting for a bounce after a pullback, things like that. So what you're doing, what the difference is, you're not just entering into a trade just because it's going up. You're entering into a trade because it's allowing you for that optimal entry point where you have a higher probability that it will continue to move up. So there's a difference between that, but putting your hammer down means that don't be shy to like trading it on that day. For example, on this day, and there are actually during July we had a lot of those days where we continued to trade, but this was the first one. We entered into Amazon with 3650 calls, and then we banked about 37% on it. And then we entered in it again with 3,700 calls, and we banked about 17 and 27% on it. And then we entered in it again at 3,750 calls. That's like $100 up in our strike price from our original entry. And we banked again like almost 89%, 23% was our first exit, 89% was our last exit. So that's putting hammer down, that we are not limiting ourselves in the amount of gain we can make just because Amazon is up 100 points. It doesn't go up 150 points, which it did. And if you limit yourself in that way, then you will limit your profit potential. So that's what we did on that day. And shop actually worked great the next day when we actually the same day, my bad. We enter in Amazon. Actually, this exit was the next day, but we enter at the end of the day, like around 9:50, exit around 15:50, left some position open just to see how it will go the next day. And it opened at $50 and you get lucky. Did I plan for $50 exit? No, it just happened. And like I always say, if you continue to follow rules and if you continue to trade the way you're supposed to be trading, there will come a day where you get lucky and make huge amount of money. That was that day. Nobody could have thought that it would go to $50 the next day, that $9.50 calls. That's almost 400% profit on your investment. But did I plan for $15 exit? Absolutely. That was my plan. I thought they would go up like about 50 to 60%, and it did. But did I plan for 400? No. So, but as long as you follow your rules and you're what you're supposed to be doing, there will be days where you get lucky and market favors you and you make huge gain. But if you are not in trade, if you're scared, or if I stopped here because I'm like I already made like 5 trades, I already traded shop twice, I will just trade it next day, or there is no reason for me to trade it again, I will lose, or anything like that. You see a trade, you take it. It's as simple as that. But then you also have to know when not to trade. So this day was a great day of putting hammer down. And then the next day we did the same thing. And then we tried to trade shop again, and it failed. And we stopped out at $11. And we were like, all right, calling it a day. We already traded shop like almost 3 times the day before. It worked out great. It's going down, let's not trade it. But then we entered in the same call again at $7, almost $50 down from that, and we made some of the money back. So it depends on the trading environment. And then the next day on 07, 08, we didn't take a single trade because the market was not behaving the way we would have liked it to. And I thought that, okay, it's a good day to just not trade because there are no good setups. So we didn't trade at all that day. And then the next day we took a couple of autos. It kind of worked out great. So that was a good thing. But overall, very good week. The only thing I can see that we could have been improved is like the early exit on this NVIDIA call instead of taking 100% loss, like how we did with shop. But that's a very difficult thing to master anyway. It's on my radar. I know that I need to improve on that one. So I am working on it, and you all should be as well. But if you have a smaller account, just because you kept your size in check, you lost $400 and not like $1,200 or $1,000. Which is kind of like it kind of make up the previous week you already made more than that, so kind of evens things out. And then and then you trade some other things and you make that money back because your losses are smaller. And now comes week 3. We this was the week, some of this trade, this was the week where the earnings season started. Some of the things could have been avoided. Banks were strong, so instead of Goldman Sachs, I went with JP Morgan, and that trade failed. It was an earnings lotto, so it was a toss-up anyway. Could have made 100% or could have lost 100%. So that's why we kept size small. Earnings lottos are usually half the usual size that I take. So if you were taking with 700 position, your earning lotto should be $350, in which this was, and it went to 0, and that's okay. And then, but basically, Shop and Amazon again the trades, but it was again. We got out of it pretty much break even. Snap wasn't doing what I thought it should. It was ready to do, but it didn't. So we just manage our position. And there's a note here that reminds me that I should have been a little bit more patient with it because it went up 30% after I exited the trade. But that's okay. That I followed my rules, and that's all that matters. And I didn't lose any money. But this was a little bit tough week to trade, as you can see from the number of trades that we were taking. So Monday, Tuesday, we took about 4 trades each day. Tuesday was pretty good, but then Wednesday, we only took 2, 3, and then 3. But we got like 2 or 3 losses this week. But those were like small losses, right? So here we got out at about 50%, called it a day. And then Netflix was an earning lotto as well. So that was also a toss up. It could have gone in either direction. Again, smaller size. So we lost about $360 there instead of 700, which is good. And then Amazon was also a lotto on Friday that didn't pay well, went to 0, and that's okay. It's a lotto, so you take a smaller half size position anyway. So we lost about $294. So we saw this week was a little bit tough to trade anyway, but we did quite well if you ask me. But some lesson to be learned is that if you have a smaller account, like for example, $10,000 account, avoid trading lottos for names that you're not familiar with. That's the lesson for me personally. I've never ever traded JP Morgan before, and I just decided to go with the lotto, and that did not pay well. So in hindsight, this trade could have been avoided. So that's the lesson here for week 3, is that don't enter into earnings lotto in the companies that you're not familiar with, because you don't know what it's going to do. And I should have known better, but it is what it is. You learn and you move on. You won't make the same mistake next time. Netflix, yeah, that's an earning lotto, so there is nothing to do there. We knew going into it that it could go in either direction, so it is what it is. Week 4 was a fantastic week. It fantastic week for the stock market itself as well as for us. Earnings week, a lot of companies reported earning that week, but we put the hammer down again on Monday. We took about 6 trades. Roku, we traded in both direction for puts and call. Shop, we traded twice, 1520 calls, 1550 calls. We traded the trend up. We made about 148% was the highest exit. The next time it kind of struggled a little bit, so we stopped out at about 820 and called it a day for that day. But Roku was the highlight of that day, and we traded in the both direction along with Shop and Amazon. The next day we traded Roku again. We traded Netflix for some good gains. We traded Shop for some good gains as well, about 30%, 26%. Overall, solid week. Made and again, same mistake. of trading mRNA. Couple of weeks before that, it was dipping down. Every time it gapped up to like about 350 to 320 range, it was dipping down to 300 and 280, 90 range. So that was and it was bouncing off of this, I think it was 310 level quite a bit. So that was my reasoning for it to enter it. I thought it would broke below, but instead it started to run on the upside. And that's okay. But in hindsight, could have avoided that trade. Betting against the overall trend was a bad idea there. The overall trend was on the upside, so I shouldn't. It wasn't smart idea to play puts there when overall the trend is upside, but it is what it is. Won't make that mistake again. And if you disregard that, the only trade that failed was a lot of play on Friday for Roku. Trade worked out great. We made some great gains as well, 140%, 100%, 88%, 420%. That was the earning lotto. We got out. If you played it, you realize power of that luck and playing by your rules and following your rules. If you looked at it, that earning lotto, you should have thought like, okay, it's $200, 275, fits in my trading position. I'm gonna buy two because it's about almost like about half a size, a little over that. And you would have walked away with almost $1,800 the next day because, well, it went almost to $12 to $13. It opened around that and it stayed around that the entire day. But this is what I mean when I say that if you play by the rules and take every single trade that you're supposed to be taking, you would get lucky. But if you thought that, I don't want to do it, I don't want to play lottos, you're still right, it's fine. But you would have missed out on this huge gain. Or you get discouraged because of this two earning lotto the week before, or the Netflix lotto that didn't work out and you lost $360, and now you're thinking to yourself like, I have no business playing lottos or earnings, even if it meets my criteria, then you would have missed out on this huge gain here. So that was the week 4. Again, amazing trading by us, like only 2 failed trade, and one of them was a lotto trade on Friday. So, and one of them was the trade that we had no business taking in the first place. But other than that, great week overall. Comes week 5, the busy week where a lot of big names reported earnings like Shop, Amazon, etc. We had Amazon and Shop earnings auto that both failed. If you were to have a smaller account, you would have only taken this one, $650 one, and you would have lost $650, and that would have been okay. We traded Snap that week a lot, and we made a good money there as well, 40% return on investment. One of the trade that failed was Amazon, 4,000 calls. That was the earning lotto, failed miserably. As you all know, Amazon tanked almost 260 points after earnings. Google lotto worked out great. We entered 2750, 1520 was their lottos. If you were, again, followed your rules, you didn't take it, but that trade opened at around 20, went to 25 the next day. And then on Wednesday, we traded Google exclusively pretty much all day, almost 3 trades, same strike price. We keep on trading it again and again and again because it was giving us good setup to enter. And we made about 45, 48, 40% return on our investment, which was great. Then Snap, and then on Friday, Tesla was running, everything else was falling or trading sideways. So we focused on Tesla and we made some good gains there as well. But this shows you this Tesla day here, this Google day here, or this Roku day here, that when a stock is running and is strong and have a great momentum going on, you can make good money just by focusing on that one name. You don't have to try and scan through 10, 20, 30 stocks trying to find where is the best setup, where you know that most people are trading Teslas and Tesla is going up. Then why not trade Tesla? Most people are trading Roku and it's making 20, 30, 40, $50 move. Then why not trade Roku? Why trade everything else? Roku has, obviously, that name has the momentum, that name has the most eyes on it, that name has the most volume. Then that's the name you should be trading. And this is what it looks like. Tesla, Google, that day it was Google's day after earnings. So that's what we traded all day. And same thing happened Roku here. That was the Roku day pretty much. And we traded Roku pretty much all day because it was working. We pretty much traded until it stopped working. And actually, even after we exited out of this one for loss, it went up big after that. This shows you that when a stock is running and has momentum like Shop this day, we traded it 3 times. It shows you that you don't need to focus on anything else. Just focus on that name that everybody else is focusing on, and everybody else is trading it for a reason, and it has a momentum that you can capitalize on. You already have an edge because it has the most number of, it has a huge volume, it has range, it's running right now, it has the momentum. So you already have an age. All you have to do at that point is find an optimal entry and exit points, and you're done. You don't have to do anything else. Whereas if you try to find other names, then you will have to look at the volume. You will have to look at how much the range is, where it could go, where it couldn't go, what would be the stop point, what would be the resistance, blah 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 blah. You have to find an edge, but when a name is running like how Tesla and Google was, you already know that you already have an edge, and now it's your job to just find optimal entry and exit, and you can make easy money on that. I hear people say that trading is not easy, and I absolutely agree with that. Trading is not easy because most people don't take time to learn, observe, and 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 basically develop that habits and patterns that makes them a better trader. But when you get to that level where everything comes to you naturally, in a sense that you know what you're supposed to be doing, like, okay, Tesla is running, that's what I should be trading. Then it becomes easy because your job is a little bit more easier. You already know what to do. You already know where you should be focusing on, what should be the optimal entry point, how to draw a trend line, what is there's different patterns that start to emerge in front of your eyes, and trading become easier. But it's not a get rich easy scheme. Like, you will have to put in some work. You will have to, one of the things is you have to start writing trade logs. You have to start making notes. You have to know what you did wrong, what you did right, what do you need to do better. Just by looking at this this trade log right here, you can see that every time we focused on the stock that has been running big, Shop, Amazon, Google, whatever it is, it worked out great. We had full 100% success rate on those days. So that's what we should be doing. Pick a name, stick with it when it's running, obviously. Same thing here, Roku. What we shouldn't be doing, just by looking at this, I know I shouldn't be trading the names that I'm not familiar with, like JPM, mRNA, stuff like that. So these things you will know once you look back, once you pause for a little bit at the end of the month and take that retrospective journey through your trade log and be like, okay, I should have done this better. Be your harshest critic. Don't, because nobody else is going to do it for you. I don't know what trade you took, what trade you didn't took, or why you took the trade that you took. I don't know that. Nobody else does. So be your harshest critic, because that's how you're going to improve. Don't fool yourself into thinking that, oh, it's just my bad luck, or oh, I'm just bad at trading. it just wasn't my day, you know, like I've been doing great, but that just wasn't my day. I'm doing everything fine. It's just market is shitty. No, don't have that attitude, because that's not going to help you. Try and find mistakes that you made. Be your harshest critic. That's the, if you can take one lesson from this LeapMeet, it would be that. Be your harshest critic. Criticize yourself. See what you could have done better. Be honest with yourself, and then improve on that. And that's how you're going to get better. And with that, I'm going to end the TradeLog review and open the floor for any questions if you guys have any. And if not, then we'll go ahead and end this meeting here.
Hey, hi, Yash. I had a question.
Hey, Chirag, can you speak a little bit louder, please?
Is it fine now?
Yeah, much better.
Yeah. So I had a question. So if somebody has a small account, but at the same time, if they see that like one of the contracts or one of the like option contracts is going slightly above their threshold, still, is it more wise to stick to your numbers and have a strong cutoff saying, okay, if this is beyond my my range, so I simply wouldn't be looking at it? Or you should have that judgment in terms of even if it goes slightly like 20 or 30% over your cutoff range, say if I'm looking only at contracts of $4 or $5, but in case I see something which is really good and I have conviction of even if it's like $8 or $9, should that be considered, or you should stick to your rules?
Um, no, it should be considered. That cutoff point, your trade size, is your guidance, which you should follow 90 to 95% of the time. Like I said, nothing in trading is absolute, right? Everything is evolving. So for example, let's just say, and I actually did include that here, we had great trades with Amazon that week, right? 1, 2, 3, 4. We already traded Amazon 4 times. Now you have a smaller account and you saw that Amazon has been on the run. We traded all the way from 36.50 to 37.50. Then you can take that chance and be like, okay, what is your conviction? Amazon has been on tier lately. It's been doing great. How far it is? So for this example, roughly the cutoff position size is 700. I have had good week that week. Then I'll be like, okay, you know what? I'm gonna push the envelope and I'm gonna go for like maybe 100 or maybe $150 higher than my cutoff price or my max trade size, and that's okay. Um, but don't go like, if your max account size is 400 to 500, don't go buying $800 or $900 or $10,000 contracts, because now you're just doubling it. But if your cutoff size or if your max trade size is $400 to $500, and you have a good conviction for a $600 or $650 contract, then it's okay to get it. Even 700 is okay at that point. If you have had good week and if you're in profit, you can always risk a little bit of that profit that you made that week. So think about it that way, right? So for example, another example is right here, this shop, right? So that day shop was running like hell. You have a smaller account, you're looking at it and you're like, okay, you know what? Shop is doing great. So I already traded twice from 1520 to 1550, and I'm in it again for 1550. Then you can be like, okay, you know what? I'm gonna take a little bit more risk, and I'm gonna enter in it. And what's my conviction? Shop has been on TRA lately too. Like we traded this week, we traded week before successfully multiple times. It's been doing great. I have made profit. Then I'm just gonna enter in it and take that a little bit of risk, right? But even if you don't take that, so with all that risk and stuff, like at the end of the day, I forgot to show you guys. So if you were to take every single contract that I did, you would have made $10,000. It's unrealistic because let's be honest, you won't be able to get into every single position that I did. But let's just say you did. then you would have made this much. But realistically, if you were to take roughly $700 position on this one, then you would have made about $6,000. Now, this is including all this outliners. So let's just remove, for example, 825, it falls outside of your account size. So I'm gonna go ahead, actually, I'm gonna do it on this one, sorry. It's the same stuff, 6 with 60, 1052. So I'm just gonna go ahead and turn this to 0 so that one goes away. I'm gonna go ahead and this one, because it also falls outside of your 700, I'm gonna take that away. Are there anything else? Nothing I see. Pretty much. Yeah. So even if I take 2 of those straight away, right? So I end up with $4,200 on my $10,000 account, which is still 40% increase in your account size over a month. And the point, I'm not trying to throw these numbers at you, right? The point I'm trying to make, even if you follow your cutoff size and your trade size strictly, yes, it will lower your profit, but you will be trading safely and you will still be making those gains. You will still, instead of 60%, your account will increase by 40%, but you will limit your risk exposure significantly, right? So instead of risking that $1,100 or $850 on one trade, which is like almost 8 to 10% of your account size, or if your account is $10,000, which is a huge amount of risk. So if it were to fail, it worked this time, but it could fail, right? Like in trading, anything is possible. So if it were to fail, it will wipe out almost, if those 2 trades alone will wipe out almost 20% of your account size. So that's for you to decide, is it worth it? But if it did work, then it will increase your account size by almost 20%. So it's a toss-up. If I were you, I would be playing safe for now, at least until you have a couple of good months, profitable months, and then you can start taking those risks a little bit at a time. And you can start doing it more as your account grows, as you get more comfortable with taking those bigger size position. But if you're just starting out, I would play it safe, because I would rather not risk 20% of my capital to make 20% profit. I would rather risk 10% of my profit to make another 10 or 20%. You see what I'm saying? So that's how I would think about it.
Okay, sure.
Yeah.
Thanks, Yash.
So yeah. So like, again, just taking this example, you're starting with $10,000 account, you follow all your rules, your account the next month is 14,000, right? Your account grew significantly. So the next month you can take a couple of those trades. So even if you lose, let's just say you took the same 2 trades again next month and you lose $2,000, those $2,000 is coming out of your profit, not your capital. So you have that profit buffer room. So once you have that decent size profit buffer room, then you can take this additional risk. But if you're just starting out, if you just getting going and you made some money here and there and you're still finding your groove, your rhythm, then don't take that risk. Just stick with the rules, follow the rules. Your account will still grow. You might miss out on big profit, and that's okay. You will get your turn. Most people don't understand that. Most people want fast money. Most people want to get rich quick. They don't understand that if you just stay in the game long enough, you will get your turn and you will win and you will have those big wins as well. All your focus when you're starting should be staying in the game and being consistently profitable. It doesn't matter if it's 20% or 30% or 40%. That profit will start to add up. And before you realize it, your account will be doubled within 4 months. And now is the time to take a little bit more risk, but not at the beginning, not when you're trading with your capital. Take added risk when you have that profit buffer. And that's how you should be thinking about it.
Okay, perfect. Thanks, Ash. Thank you.
Any other question? All right, then. Thank you all for joining us on this fine Sunday. We'll see you all tomorrow. And I hope you guys learned a thing or two from this webinar. And as always, if you have any question, feel free to reach out to us anytime, and we'll be more than happy to answer your questions or help you out. Thank you again.